So sorry for disturbing at this moment. Professor Sampath, the UGC chairman, now he with us today, but he's a little bit busy yesterday. Professor Sampath, are you with us?
Yes, yes.
Yes.
Yes,
yes.
Sampath is there. Sampath is there.
Yeah. So he's doing very good job for us, particularly for the Sri Lankan Academy. So he's not a new face to us. He's always helping us. Not Sampath, would you like to say something?
Yeah, Professor Pandey is a long-standing friend of Sri Lanka, I would say. I can still remember he visited the University of Sri Jayawardenepura Management Faculty when I was the dean, and continuously helping our products of Jayawardenepura for a long time, mainly Vasanta because of you. And this time when you proposed this to me, I wanted to open up Professor Pandey's contribution to all of us, not only to USJ. So we have opened up. So I quickly went to all participants who are participating. So all universities are representing, especially from finance departments. So Professor Ajjo also there, I can see. Professor Pandey, my heartfelt gratitude for you to coming all the way online and teaching and sharing your expertise with our young academics here. Thank you so much. I don't have words to thank you. You know, we'll meet very soon when this epidemic, yes, this thing is, yeah. So thank you so much, Professor Pandey. Thank you. Thank you.
Thank you very much, sir.
Yes.
Thank you very much, sir.
Yes. Bye. Bye.
Thank you very much, sir.
Bye. Bye.
Thank you very much.
I always enjoy interacting with the faculty members. So thanks for the invitation.
Thank you.
Thanks,
Thank you
Professor.
very much, sir.
Thank you. Thank you.
Thank you very much, sir.
Thank you. Bye. Bye.
So sorry for
Bye, sir.
disturbing. You can continue your session.
What is the equity beta of this company, that is Marriott, in 1987? Equity beta, how much is the equity beta?
1.11.
1.11.
Okay, very good. And what is the sales contribution of lodging division?
Pardon?
What is the sales contribution of lodging division in
41%.
41% in 1987.
Yeah, very good. That is correct. And now what are the three divisions which they have? What are the names of these divisions? Lodging is one, of course.
Lodging, contract service, and restaurant.
And restaurants. Very good. And okay. Well, so there are
Not clear.
kind of numbers which we need to remember actually. And we should also know that where the information is available, what is contained in various exhibits, exhibit 1, 2, 3, 4. They have 5 exhibits, of course, right?
So not clear, sir. Question is not.
So could you find questions themselves or no? Because I can find out them from my email to you. No, it doesn't work.
So shall I show using my screen to do all the questions?
Yeah, one by one.
One by wow.
Or you can show all.
Oh, wait. Sir.
Yeah, show everyone.
Wait, sir.
It's okay if you are not able to find it.
Wait, sir. I will. Wait.
Okay, I have the question.
Yeah.
These are the questions.
Yeah.
So, merit beta, some of you answered it 1-1 this. And merit, what is the Marriott's debt to total capital ratio in 87? 59, 46, 20, 19. What is the debt to total capital ratio? No? It's given in one of the pages.
59%.
Huh?
59.
Yeah, but quickly. Corporations contribution you have already indicated. Now, what has been in 1987? What is the growth in sales?
4%.
24%.
Huh?
24%.
Okay, correct. Then after that, what is the question? Next question, I can't see that.
Only 4 questions, sir. Yeah.
Only 4 questions. Okay,
Yes.
good. So at least some of them know the answers, which means they have read the case. Now,
Shall I stop sharing?
Yeah, you can stop sharing this one. I think what I had given to you was, in case as you must have read it, that it focuses on the calculation of divisional cost of capital, not the firm's cost. Yeah, of course, firm's cost of capital, but I think focus is more on the divisional cost of capital. Most of the time in MBA programs, we have been teaching firm's cost of capital, but then the firms may have multiple divisions, right? And those divisions may not have the same kind of a risk. They may not have same kind of debt equity ratio. Therefore, conceptually, you cannot use firm's cost of capital to evaluate projects in divisions. That's why there is need. So this case focuses on that particular part, that we need divisional cost of capital. And this case again, therefore, it wants students to work out cost of capital for the company as well as its divisions in a real setting. Because textbooks may not give you practical information or data. And therefore, when they are required by the companies, when they join companies actually, I remember one of my students in Ahmedabad long ago, who was doing his internet, what we call as internship project in a company, and the company asked him to calculate cost of capital. It's international division actually. And then he called me because theoretically he knew, but he didn't know that how to handle it practically. So these cases, in fact, help you to think practically, in practical terms. What kind of data is available, what is not available, where from to get the information if the information is not available. Even the cases will make all data available to you, but practice you have to collect that data. When you look at Exhibit 5, etc., where do you get the data? You may not. America, it's available. They are database. In developing countries, it may not be available. The databases are inadequate. So it tells you that if you are in a different country, what information you need to collect. Now, what I would like now you to tell me that I'm assuming that you know how to solve this case. Okay, I'm assuming that to begin with. Now, if you have to teach it in a class, how would you go about it? would you expect your students? And in advance, if you want to give them any instructions, what instructions would you give? Similarly, how much time would you take to discuss which aspect of the case? Because your detailed plan should include that. So if anybody has prepared any plan, can just give a
I
little.
have done a little bit on
Yeah,
this plan.
Hemanta, yeah.
So I can share it, but how do I share it?
Vasanta will allow you to share.
Yeah,
No,
yeah, yeah, yeah. We have shared you. Mr. Hemant, you can share it. You can share the screen now.
so
Right.
this is actually my plan. So what basically I will give this case 7 days at least week before to the students with few questions, key questions, because I will go through this in thoroughly and understand whatever the information needed, and the students should be understood. So then I prepare the question like that, and I will give the case with that question, them to answer that question, finding information from the case. Then at the class, so then I basically find out from the students the main issues and the computations to be done for this case. Then the third stage, then I will ask them to get request, find the division and discuss what are the divisions available and their characteristics, because these divisions are basically belong to the risk factor of the total Marriott. So it's important to read through the characteristics and the important factors given in the case relevant to the divisions. Then request to find the target capital structure is important. This was given in the case because you have to levered beta has to be calculated accordingly for the division and the Marriott again. Then the request calculate the appropriate cost of debt using table A and B information are available. So for division, then the request to calculate tax rate, because you have to calculate the tax rate using the information in the table 1, expression 1. There is a tax amount and the net profit. So that basis you have to calculate it. Then the request to find out comparable levered beta for lodging and restaurant, because those two division only comparable information given. So then you have to find out how to find the unlevered beta for contract division. So there are information given in the identifiable assets of these 3 division, and the total 3 division is the Marriott beta. Marriott unlevered beta has to be calculated upon levered beta, and then you can put the weight of the assets and find the this thing. So I will ask the student do, and we will discuss that. Then calculate levered beta each division as in the structure, capital structure using. Then discuss the available methods to calculate cost of equity, and then appropriate method I will discuss and find out is a CAPM. Then we have to find out the request calculated risk premium is available in the exhibit, because there were so many US government security rates and the bond for the from 1926 to 1987 given. Which one should be appropriate for this? We have to find out, because there were what is called the spread was given for the return to market return to this free return was given, and in addition some more unrelevant information also there. So students should be able to identify that. We'll discuss that. Then request find the appropriate risk-free rate. That also is division. That was for the some short-term thing. Security has to be considered for 1 2 division, and that we have to discuss. Then they use CAPM calculations to find out the divisional cost of capital. Then you have the weight was already there. Then you can calculate WACC. Then finally we will discuss the divisional, because they have a financial strategy given for this Marriott case. So whether this division cost of capital is really may find the, so we have to discuss with the student. That's the way I will approach this case to the student.
Okay, good. That's good. How much time you are going to devote? Of course, you have allocated time.
The
1.5
discussion will take with the students giving work in at least 2 hours, 2.5 hours. In this
Uh-huh.
case.
How long are your classes generally?
So 3 hours.
Okay, 3 hours classes. All right, that's good. So 3 hours is a good enough time to complete many things as you have indicated. Now Nilangi we also wants to make the presentation.
Nilangi as well as Pandey sir, Win also, another participants also, after Nilangi, he also has indicated his interest.
All right.
Okay.
Okay.
Okay. Okay, Mr. Hemanta, can you please stop sharing the screen?
Yeah, okay.
Okay, so Ms. Nilangi could please stop sharing your screen. You have to stop share. Share screen කියලා stop කරන්න Mr. Hemanta.
I have to find it.
එතන අර මේ ආයෙත් අර කොළ පාට බටන් එක ළඟට ගිහිල්ලා එතනින් චුට්ටක් ගිහිල්ලා තිබුවම තියෙන stop share කියලා. අන්න හරි.
This is not sharing. It's new
share. ඔබතුමාගේ screen එක තාම
share වෙනවා තාම. stop කරන්න.
stop share කියලා දෙන්න.
okay good.
ආයෙත් අර කොළ පාට බටන් එක ළඟට ගිහින් පොඩ්ඩක් හොව කරාම අන්න right. Thank you.
Nilangi, you can
share your
screen.
Okay, Miss Nilangi.
Okay, sir.
Yes. Okay. You can share your screen now.
Okay.
Okay.
When you present, perhaps you can unmute your video also. Other we can mute our video.
Can you see it, Adra?
Yes. We can see it very clearly.
Yeah. Professor, this is my teaching guide. So I have started with my learning outcomes.
Ms. Nilangi, a small thing. Ms. Nilangi, can you little bit expand the screen? That means there you can see it says over here that you can over here you can see over here it says you can see I have highlighted over here down here. Okay. Over here you can enlarge that so you can see it clearly. Okay, that's good. That's good. Excellent. Please go ahead.
So I have started with the learning outcomes. So I have also prepared the slideshow. Based on that only, I have prepared my teaching guide. So it starts with understanding the concept of cost of capital, weighted and divisional cost of capital. And then you have the analysis of the Marriott Corporation as well as how to calculate the weighted average cost of capital for the whole organization and then the divisional parts. And finally, how to prepare a summary based on that analysis and then your recommendations. So first, I was thinking of 2 sessions. Normally, we take about 1.5 to 2 hours per session. So initially, we'll talk about the background in the first session and the analysis part in the second session. So first, I want the students to engage, like get into the case. So rather than, I will be giving the case to the students and so they have to engage where they start reading. And so this is my learning outcomes and this is my slide 3. As you gave us the questions, Professor, I think it's a way to engage the students. So you ask general questions. Here we won't be looking for specific answers. So like they have to revisit their understanding. What is cost of capital, weighted average cost of capital, and the divisional cost of capital, and then beta, and also a levered and unlevered beta. So they revisit what they have learned. I assume they learn through a lecture or else they go through their study material and revisit that. So I think this should be done in groups, a group of 4 members. And then in the first session, they will be discussing this. They will go through their material and discuss these questions. Okay. Saying a group of 2, 2 members may discuss and they discuss it in the group. And also in my teaching guide, I have also identified the answers. I won't be giving the answers. I will let them talk, discuss it. But these are the basic answers for the questions in the slide. So what cost of capital is, what weighted average cost of capital is, and then the divisional cost of capital, where based on the divisions there can be separate cost of capital, so how it is calculated, and why you need the divisional divisional cost of capital, and then how to calculate the unleveraged beta, leveraged and unleveraged beta. And then we'll move on to the case. This first one was just background knowledge, and then we go to the exploring stage, where I identify two parts where you have to understand the organization first. So you understand the Marriott Corporation with special attention to their growth objective and also the financial strategy. In the case, they say they have 4 key elements in their financial strategy. So the students should understand the background and also based on the growth objective of the organization. And then it will be in the slide 4, where I'll show it to the students. So let them discuss in the group and develop the background of the Marriott Corporation. And they have to write that up, written summary on the corporation, and then come to the analysis. So first we will look at the Marriott Corporation taken as a whole, how to calculate the weighted average cost of capital, and what is, so here first in the first, this is I think 5th slide. What is the weighted average cost of capital for the Marriott Corporation? And what if they use that to evaluate investment opportunities? But what if they use the weighted average cost of capital of the whole firm? And then we move on to divisional part. I was even when I was making this, I was thinking, should I give these questions? If I give these questions at first, they won't try to find them. So I thought of what to do is for them to explore the divisional cost of capital and things like that, and finally show the slides so that they will be focused. They will discuss in the class, and this is in the session 2. They will discuss within the group, and finally I will give this for them to be more focused. Okay, and then they will explain and elaborate their understanding. Get each group to present their findings and elaborate. When you come to this slide, explore Marriott Corporation. So whatever we talked about specifics, weighted average cost of capital, divisional cost of capital, and then how to calculate the levered and unlevered beta. All these details will be calculated by me, which I will have it, but I will let the students make the calculations. And then the explain and elaborate stage, they will do a group presentation. But if we have a large class, it won't be practical. We won't be able to take all the presentations. So we will select few groups randomly and tell them to present. And then I will also show them how I'll be evaluating the case study. So there will be some marks for the report as well as the presentation. No marks will be on the calculations. 30 is given for the calculations. So this is the background of the company. Likewise, how they will be marked will also be discussed in the class. So this is how I thought of teaching this in the classroom.
Okay, okay, good. Good.
Professor Pandey, sir,
yeah.
there's another person who wants to present. Owen, can you can now share your screen?
Yes,
Yes.
sir. So, sir, here,
Yes, sir.
if you give me a second, so because the sound is not clear.
Yeah, you have 2 devices, I think.
I think
Yes,
we have 2 devices. Please put that.
Give me a second.
Okay, okay. Please take your time.
Hello, sir.
Yeah,
Yes.
we can hear.
Yeah. So according to my teaching plan, what I think was to give a quick recap on cost of capital about WACC calculation, cost of debt calculation, beta calculations and all. And since students are not, most probably they are not reading the case study prior to the class, I will give them to read the case study. That means I will divide the case study into some sections and tables. And as an example, one group will explain about the company's background, and the other group will explain about the 3 major lines of business, and the other group will explain the financial strategy. Likewise, I will give them time to present their section, and I will ask questions from them to clarify all the doubts and all in their section. Then I will individually assign them to calculate the weighted average cost of capital components. Here I have prepared some slides regarding the explanation part. Now the company background, how it will be divided among lodging, contract services and restaurants, and what is their financial strategy, and how to calculate the cost of capital. Then when we are calculating the cost of capital, first of all, we must calculate the cost of debt. So to calculate the cost of debt, in the case study, they have given the way the debt rate premium above government plus the long term or short term interest. Likewise, I will give them to calculate it. And finally, I will take the class and explain how the entire procedure was done. Thank you, sir.
Okay.
Thank you, Wayne. And you can put us to sharing the screen.
Sure.
Any other person? That's it. Okay.
Any other
I
one
think-
present?
Yeah, or can react on these presentations. Anyone can react on these presentations. We like to add something or may say that this part is not relevant. No one. No. Well, let me ask these 3 questions. Now, when you design your course, what chapter or what topic will precede this case? What you would have done before introducing this case in the class? Now, let's say that you have a financial man. You are teaching, let's say, a course on financial management, okay, to the MBA students. Actually, in the case of undergraduate, if you want to use, then you have to have very short cases, not very complicated. They will not understand, right? So then you use cases to clarify certain concepts, theories, and techniques there. But in MBA classes, the issues are a little more complicated. They are not only computations and application of theories, but it requires a lot of other kinds of thinking. So that distinction is always there. I'm assuming that we are using this case for MBA classes or in the executive development programs, MDPs, management development, whatever you call them. Now, let's say that if you are designing a course for MBA, now where would this case come? What you would have done before this case is introduced? Yeah, I want answers from anybody or these 3 persons. Any one of you can answer. Is that clear to you? What topics or topic will precede before using Marriott cost of capital case?
Immediately before this, I think it will be the chapter on cost of capital. And before those, you would have done separately the cost of each source of finance, like equity capital separately and say bonds separately. All of them taken together, you would have done the cost of capital chapter.
Okay.
Not only that, they need risk and return understanding, especially need to have an idea about beta calculation.
Okay. I think, yeah, that's correct. Now, really speaking, what we do here is how do we design course is important, number one. Then how do we want to use case? Actually, in most of the situations, in a large number of colleges, universities, if MBA students are not highly motivated and matured, you cannot use only cases. So you will combine your lecture come discussion. Never give a 100% lecture. Let it be lecture come discussions. What does that mean? When you are giving a lecture, now make it more interesting in the class, of course, by asking students to answer, relate what you have talked about. You may speak for 10, 15 minutes, and then again, you may ask questions, discussions. Now, generally, the institute where I taught for a quarter of a century, IIM Ahmedabad, there we will give the reading material along with the case well in advance. Actually, the entire materials and the course outline is given at least a month before the course starts. So they know the number of sessions. They know the textbook, if at all there is a textbook to read. If there are articles in second year elective courses, we give articles also, but first year generally there would be a textbook, except in courses like macroeconomics, where articles are important. So you know everything in advance. So you know what chapter to read or what technical note. Now sometimes, because textbooks are for the students to understand at their own, you don't need a teacher. The good textbooks, they explain. If you read seriously each and every line and the examples given in a textbook, a student can understand it, unless it gets into some very highly technical topics. Otherwise, he or she can understand it. So why do we need the teacher is the question, all right? So in IIM Ahmedabad, in some of the courses, we will expect students to read the book chapter themselves. So we don't give any lecture. It is through case that we are trying to understand whether they learned from their book or not. Okay, we are asked questions. In case method, I think avoid making any presentation whatsoever. Don't make any presentation. Don't say, let me summarize now. No, don't do that. Ask a student to summarize the discussion. Help them, of course, but actually, unless there is active participation, unless they own the responsibility of learning, well, it's difficult for them to learn. So depending on your circumstances, environment of the university, so you have to adapt. You have to adapt your strategy of teaching. But I'm emphasizing less and less of lectures, more of, even in a lecture method, there has to be a lot of discussions. So you say that, look, read this chapter on cost of capital. These are the objectives. Actually, what we do is in our course line, we write overall learning objectives of the course, as well as briefly, not in great detail, 2 to 3 main learning objectives of each topic. Okay. So that's what we write. So if there is a chapter on, let's say capital asset pricing model, well, generally you may have to devote more than one session on such topics. But otherwise, they are given to read. Okay. And if the book chapter is very long, you summarize it. We call it technical note. The teacher puts more efforts. Writes a summary, 2-3 pages, not the summary which is given at the end of the book. That's very brief. But then you can write a summary, the essential points, not the great examples and details. Give that in advance. So you must read that. You should ask your student that you must read it before coming to the class. It is around that material. If you have a lecture class, you raise questions and let them answer. They will go wrong. Don't say you are wrong. Ask another student. At least 1 or 2 will give correct answer. Then say, this is the correct answer. Take 2 minutes to elaborate it further. That is what the case method, in my opinion, should be. It should not be PowerPoint presentation where a teacher is speaking for 90 minutes, 60 minutes, 75 minutes, whatever, and the students are listening or pretending to listen or writing, or of course, everyone will say, teacher, please give us the PowerPoint. Why don't you give them well in advance? You say, here are PowerPoint presentations well in advance. Don't keep any secret with you. Let them learn. And you say, come well prepared, read this power presentation as well as textbook or technical note. And you only discuss by asking questions and then taking time to devote 5 minutes, 10 minutes on some concepts. Okay. So if they get involved, they will learn faster, they will retain it. That is lecture method. The case method, that is a pure case method. Okay. Which means it's only discussion in the class by asking multiple questions, one main question followed by many other questions so that that main question gets answered. So that should be the approach, and ask students to summarize. Don't summarize yourself. And if they can't summarize, they have not understood. In the beginning, to ensure whether they are, to make sure whether they have read or not the case, you ask these questions. Or you can give them, you can ask them to bring their computers and give them quiz. Small quizzes, multiple choice on the facts of the case. If they have not read the case, don't discuss case. Ask them, then form the groups in the class. And you say, now read individually and then discuss in your group. Then we will have the class. If you want to encourage case method, this will have to be done. A teacher said that, no, I will not teach a case. It has to be discussed and you have to discuss it. Okay, where computations, they may go a little bit wrong, help them and again say, now you complete. I'm giving you how it can be done, but I will not solve on the board. You will solve. Okay, so it depends on what you are doing. That's why I'm saying in the beginning, just introduce case methods slowly and gradually. Pick up few cases, and after your lecture come discussion classes, every 3, 4 classes, 5 classes, where various concepts have been covered already, then you can do that. Even in K class, just write some artificial, real looking. They are artificial, but they look real, little real than the textbook problems. You can develop that skill actually. And so 1 page, half page, around that problem, you discuss the concepts. Okay. So don't take pure textbook. That can also be done. But then if they're good textbooks, give good problems, small cases. So you can do that. All right. Now, in this case, what are the issues? In your opinion, just give me 2, 3 main points. There would be sub-points. Because most of you said 2 things, isn't it? Financial strategy, 3 of you who made the presentation. And then you said that there is a question of computation of costs, company's cost, division cost. So what would you like to forward? So this case is more mechanical also, right? It's more mechanical, technique oriented. Some cases are in finance, technique oriented less. More is conceptualization and then techniques. Here we are assuming conceptualization, at least the basic concepts are already been taught in the class through lecture cum discussion method or through some textbook problems or that has been already done. And then you introduce this case, okay? So what do you think, what questions do you think you will ask them? Of course, you listed out questions. Now, for example, in one of the presentation, what you said that learning objective, Nelangi, for example, learning objective, and then you said that then people wrote down even strategy, etc. And then you said cost of capital, why we need cost of, actually this comes through this case. And the case is, in this company, why you need hurdle rates. Hurdle rates is cost of capital, discount rate, opportunity cost. So that those concepts should have been clarified earlier, that there are different names, not one single name called cost of capital. It can be called cutoff rate, it can be called hurdle rate, it can be called opportunity cost of capital, it can be paid capitalization rate. Montgomery and Miller in their articles use the term capitalization rate. Okay, they don't use the term cost of capital. So that those points should be clear to them. So actually one question could be either in the, that look, why this entire case on hurdle rates, which means why this company needs cost of capital, okay, or hurdle rate. That is one question which I think perhaps you can devote good amount of time. When I say good amount of time, not more than 10 minutes, but at least 10 minutes. You cannot simply say 1, 2, 3 there. You should ask them to allow. For example, within their financial strategy, there is this question of share repurchase. Now, if you have not discussed the theory of share repurchase, or why we call in India buyback of shares, then you have to, I think you have to ask them, try to get as much as they can, but then you need to explain what is repurchase. Earlier, our Companies Act made it illegal. Now they have allowed it. Okay, the company couldn't buy back your share. So these are the things which you will be telling them, of course, because they may not know the history. And what is the importance of share repurchase in this company? And therefore, why do you think cost of capital is very important? There is a term which comes there, all right? Warranted value. What is warranted value? Anybody? What is warranted value? Can anybody answer it? What is warranted value?
Current value of the company.
Huh?
Current value of the company.
Current value means market value. Are you able to see my screen? Are you able to see my screen?
Yes, sir. Yes, sir.
Okay. So look, if I prepare a case, that's how I do it. Okay. So I write, well, I do that in my iPad where I have an application and I write by my pencil. Now this is one important part of the case. Okay. Because generally what we say theoretically that I calculated my cost of capital at, I say it is between 10 and 11%. Now what is happening here? That from 12 to, even if your hurdle rate changes from 11 to 11.5%, your NPV declines substantially, very sensitive. Value very sensitive to the hurdle rate. So I write that down before I even think of what plan I will use to teach this case, for example. Now then they say hurdle rate is used for investment and then incentive compensation. This requires time. First check with them what they understand. You can take 2-3 minutes to explain from your side. Okay. Well, of course, because they wrote repurchase financial strategy separately, but I would like to, when I start discussing, I will ask them financial strategy along with, because here the term warranted value is used. You didn't notice it. I think it's somewhere here. Okay. Well, I don't think they have used it. I am using it. Now I think I am using it. So because what is warranted value? Warranted value is what you think the value should be. And what is market value? What is it actually in the market? Okay.
So is it the intrinsic value?
Huh?
Is it the intrinsic value? Warranted value?
No, you say that this is the dividend which they should be giving, that they should be receiving, or I am paying. In my opinion, therefore, the warranted value is calculated in the same way as the present value is calculated, isn't it? So you are saying my hurdle rate is 13% or 12%. My expected dividend to the shareholders is so and so over a long period of time or 10 years. And therefore, this should be the market value today, but it is not. It is less or more. And accordingly, you make your adjustments. Accordingly, you have been making your adjustments. All right. So that is what is called, yeah, it's here. Marriott regularly calculated a warranted equity value for its common shares and was committing to repurchasing. If according to their warranted equity value, if they think that market price is undervalued, they will buy at a higher price. Okay? Instead of giving dividend directly, they will give dividend via buying back the shares. And they have given even the figure that 87 Marriott purchased 13.6 million shares of $429 million. So that's very important. So your student must understand. You should understand, and then they should understand. Ask them the question, at least let them repeat whatever is given here. Ask them whether they understand it or not. They even compare on the basis of price earning ratio with the comparable company's share value in the market. All right. So that is one question which will require at least 10 to 15 minutes to answer. That is, what hurdle rates are used for, and then what is this share repurchase? You should focus on share repurchase. Okay. This case is a textbook also, because it's giving you how to calculate cost of capital. So it is explaining everything. Now, what is debt capacity? Here is the term debt capacity. You should pick up these questions to ask to your students. What is debt capacity? What is debt capacity? Anybody? You have actual debt ratio. All right. You have target debt ratio. You have debt capacity. Now, actual debt ratio is what you have actually borrowed. Target is what you want it to be. Target may be the same as the debt capacity. It may not be the same. Debt capacity means what amount of debt you can bear, which means given your cash flows. Okay, because they have been using interest coverage ratio as the basis to decide their debt capacity. If you can service large amount of debt, so you will say that my debt capacity is very high. I can borrow even 80% of total capital. But if my interest coverage is very low, my cash flows are very low, my debt capacity is always low because I can't service the debt. Okay. So this company is again very conscious of determining its debt capacity, which perhaps they are reflecting in terms of target debt ratio, which are given in the case later on. Okay. So they say here debt capacity and cost. So again, it requires, because students' textbooks may not be giving some of these. Okay. So you need to understand. And then there is a question of floating debt and non-floating debt. Take a minute and explain this, or ask them if they are not able to give them. Then they are saying unsecured debt are A-rated. Do we have rating in Sri Lanka? Discuss rating in Sri Lanka. Or you may say we don't have or we have. I will explain in a different context, but this is what it means. So there is a lot in this case, okay? Even in terms of these details. Okay, so my one question, I will divide this case into 2 days. My days are 75 minutes or 90 minutes each. The first day I will ask this question and then I will say how hurdle rates should be determined. It's a little theoretical question, but you can recollect as one of the presentations said, but it's a recollection. You are not going to make any presentation on that because we are assuming this topic theoretically has been covered. Then we say that what steps are required to compute this company's cost of capital, cost of equity and cost of debt. And then I will, if they say, okay, these are the methods for cost of equity. There is, in this case, from the very beginning is focusing on capital asset pricing model. So I'm going to ask them what is, just to recapitulate, what is it? What are the parameters and are they given in the case? Where are they given? Where is this information available? Then I will say, what is debt cost? Okay, now it's very interesting here. That is America, of course. Here. Now these are your targets. Okay, debt capacity. These are your targets. Oh, this, my pencil will not work here because this is a different. So Marriott 60%, lodging 74%, contract 40%, restaurants 42%. Okay. How much is floating? How much is fixed? And this is the information which is generally not even taught in the classes, not given in the textbooks. Debt has a risk premium above government. So government debt is considered safe and their debt is risky. And these risk rates are different. These rates are different. Okay. So that's why you need to devote a lot of time on this part. So why it is so, why there is premium. Okay. Then I will say, okay, use CAPM to calculate cost of Marriott. Then I will say, of course, I will ask them how much is the cost of debt for Marriott and how much is the cost of equity for Marriott. Now for calculating cost of equity, they will have to determine beta, risk-free rate and beta. How would you, where is this information given? Can you tell me where is this information given? Any one of you?
It's available in 4 and 5.
Yes. Now, how much is the cost of debt?
Cost of Marriott.
Yeah.
10.25.
How did you get it?
Premium, risk premium 1.3 plus 8.95 is the government bond rate high 30 days, 30 years.
Okay. Now, so actually, you have table A from the textbook. You have table B. Now, these are the rates given.
Table A,
now these,
table B.
So now he has used 8.95% and added the risk premium. Okay.
Yeah.
This is exhibit 1, this is 2, this is 3, and this is 4. All right. Now, what is given here? So I think you ask your students before coming to the class to go through each and every exhibit and explain in the class. So short-term treasury bills. This is the average, this is standard deviation because they are risk-free. They are risk-free because there is no risk of default. Otherwise, the rates do fluctuate. Standard deviation is 0.94. These are long-term US government bond rates, and these are different time periods. Okay. And here it's this one. This is long-term. The risk is higher. Standard deviation is low. These are high-grade corporate bonds. The risk is still higher. Return is also higher. Return is less, risk is less. Return is slightly higher than this, but risk is higher. Return is more, but risk is also more. So that risk-return trade-off kind of a thing. And when it comes to the stock market, these are for different periods. Okay. So the one question is, how long should be your period? The market return is 12.1% if you take 42 years data. This is 42 years data. Okay. So can you tell me how much will be the risk-free rate? How much will be risk-free rate?
I have taken 4.58 as the risk-free rate for this because it's the Marriott and the lodging section, lodging and the restaurants, because the long-term assets are there, risk is there. So then
No, for Marriott you have taken 4.58.
4.58.
No, but that is a return. That I'm saying, what is the risk-free rate?
So can we take the government interest rate?
How much is that?
8.95.
Now look here, you have exhibit 5. Now this is the spread. Spread between SP 500 composite return and short-term treasury bills.
That's a risk.
8.47. And then this is another one. Now, so this is risk. So one is risk premium, another one is risk premium, and then there is a risk-free rate. Risk-free rate is given in the text. It's given in the text. Is it given or not?
So it's not given.
What is 8.95% for Marriott? What is 8.95%?
It's in the table B, sir. Government interest rate is considered as the risk-free rate.
No. So now, that is another question in practice, theory and practice. Now, when you are now what do you think that in the textbook, what is risk-free rate given as? What do they say? What is risk-free rate? In your opinion?
Government bond rates, they basically say to take the risk-free rate.
Short-term, short.
Default risk-free rate.
Any textbook which you read, what is given there generally? Let's say you read an American textbook. What do they say risk-free is equal to?
Government bond rate.
No.
What are treasury bills?
Treasury bills.
No, what are they? What is meant by treasury bills?
Short
Do
term.
you have them in Sri Lanka?
Yes.
And short term is how short?
There are 3 kinds.
What are they?
90 days, 182 days, and 364 days.
Yeah, okay. So they are for 90 days, okay? And then 180 days, which means quarter, half year, and then 1 year. These are 3 rates short term. And if you pick up American books, most of them will say Treasury bill rate is the risk-free rate. Okay? And if you pick up, but then the argument is, now the problem is with the capital asset pricing model, which is based on short term, 1 year. Okay? But now in practice, what are we assuming? Now, so risk-free rate should change every year. Risk premium should change every year. But in making our calculations of cost of capital for evaluating a project, let's say that my project has a life of 12 years. It is a long term, isn't it? Or 20 years. Now, if you're talking about constructing a bridge, the life of a bridge is even more than 30 years. Many years, actually. For practical purposes, we say it's very long, 30 years. So you are evaluating your investment, government is evaluating, or a private company is investing in a plant. The life of plant is practically expected to be 25 years, but then they are saying, let's assume 10 years or 15 years. And then for the remaining period, they calculate what they call terminal value. So 10 years is a long period, 20 years is a long period, 30 years is a long period. And Treasury bill is a short term. Therefore, many people argue, of course I have given that in my textbook, that it should be long-term government bond, which should be used as the risk-free rate. All right? It should be used as free rate. These are the rates which are given. Now, depending on your divisions, you have to make an assumption whether it will have a long life of 30 or more, or a life of about 10 years, or it will be short. Now, lodging, restaurant, they're buildings. What are they? They're buildings. You see, you are investing in real estate. When you say lodging, you are creating hotels. When you are saying restaurant, you are, again, it's a place. Now, of course, there are other small investments, but the basic investment is long term. Now, so here, in both these cases, it may be convenient to assume, it will not be illogical to assume that they will have long life, because real estate, 30 years at least. And remember, this is the rate in April 1988. Okay. Now for contract services, they can be very short or they can be little longer, 5 to 10 years. So you have to choose one of them. I may say, well, 10 years, 8, anyway, you can use one of them, but you make your assumption very clear when you are doing it. Well, if you don't want to commit any mistake in evaluating your project, this company is of that kind, it will be little on the higher side here, 10 years. What you are given in exhibit 5 or 4 and what you are given here, what is the difference? There also you have rate, no? But it's average for a long period. And this is the current rate. This one is the current rate, April 88. It is April 88. So conceptually, I think one has to be very clear about cost of capital. And what you have to understand is that when you say CAPM for cost of equity, so you are saying my cost of equity is equal to risk-free rate plus risk premium multiplied by equity beta. You can write symbols, of course. And what is this one? This is the current, because you are taking the decision today. You are taking decision today. So this is your current rate. And what is this risk premium? This risk premium is your average, it is expected actually. The model is expected. We don't have expected rates, unfortunately. So it is the long period average market rate of return minus its risk-free rate, okay? These are averages. Averages of long period. So averages of long period. Be very careful in teaching and as well as in giving exam questions. Because then you have to give either risk premium directly, or you say the average risk-free rate is this, average market return is this much, and current risk-free rate is this. You cannot use this rate here. You should not. If no information is given, this is the only information, then let the students do it and let them write a note. You should also tell them, write a note, that though it should be average, we are not given the information, so we are using current. Okay. Now this case brings that. This case brings that particular point to you. Okay. So this case will require more time. So now you have to calculate the cost of your Marriott. So Marriott, when you calculate the cost of Marriott, cost of debt, sorry, this one makes it a circle. I will delete it. So I will write it cost of equity. So cost of equity, let me write it here. And then cost of debt. Now here, what you have is, now you are choosing that 8.95% plus you have the risk premium. How much is the risk premium? 1.1? Hello?
130. 1.3.
Huh?
1.3. Marriott.
Okay. 1.3. And that makes it 10.25.
10.25.
Okay. But after tax cost of debt would be 1 minus tax rate. So it would be 10.25 into 1 minus tax rate. Now tax rate is not given perhaps. So you have to assume.
You have to calculate. You can calculate it.
Well, that is the effect. We have to use marginal tax rate, and that is the effective tax rate, what you actually pay. But that can give you an idea. So you have to make an assumption. In USA, corporate tax rate generally 34% in 1980. Before that, it was very high. Still, it may be high, I don't know. So anyway, that assumption has to be made. You can try to find out. If it's not there, don't take very low, don't take very high.
It's 44.
So
44%.
If it is 44, you take 44, all right? So I'm simply writing tax rate. In my calculation, I took 34%.
So when you go to the exhibit 1, there is a profit and net profit and tax was there, paid tax. then you divided by the tax 175 point some million divided by 398 million net profit. So you will get the tax rate as 44%.
But can you divide tax amount by net profit? Because net profit is after taxes.
No, not before tax. That's what they were given the before tax operating profit sum. I saw that.
Yeah, that's fine. You can use that. You can use that. You can take even 2-3 years average if you like, because. But if the rate is not given, we have to use our judgment, or either we should have that idea, because in that country, this is a very old case, so we don't know how much perhaps it was in 87. So we don't know that. But otherwise, what you have done, that can be used. So in exhibit, we do have that. So net profit is there, and income taxes, income before, so 35.4 divided by 83, 87, the amount is different. And you can calculate, roughly calculate, because I checked even the footnotes, the rate was not given.
No, that actually it's given income before taxation 175 and tax was given.
So you can find that out. So roughly your tax rate can be tax paid divided by profit before taxes, right? Which is equal to your PBIT minus interest, which is given, which is directly given actually in the case. Okay, now cost of equity, what you have to find out the risk-free rate. So risk-free rate from exhibit, if we look at exhibit 4 and 5, we have to take long term, very, very long term, not short term. So 26 to 87, we have market rate of return is 12.1%. Actually, it is given in exhibit 5 directly, but I'm saying minus the long term, it is 4.58. This is exhibit 4 and this is exhibit 4. So when you do that, you get this. And this information is directly available in exhibit 5 as the spread between market and the long-term government bond. It's given in exhibit 5. So this is your risk premium. Okay. So what is this risk? This one is average market rate of return. It's average market of return. And this one is your average risk-free rate. And the difference is risk premium. It is given here. Now, as I said that, the first RF, so actually your formula should, so that is given as 8 point. How much is that given? Risk-free rate, April.
Hello.
How much is it?
What is?
How much is it?
Yeah, Mr. Hemantha, you can tell it. We didn't hear you. Mr. Hemantha?
Yeah, I cannot hear.
Yeah, Mr. Hemantha.
What is the question?
Professor
The question is that to calculate cost of equity, how much is your risk-free rate? We just calculated risk premium, all right?
Yeah.
How much is the risk
rate was 4.58 plus beta, calculated beta was there. And then I take the risk premium 7.43. It was there.
Risk-free?
4.5. I took the 4.58 as risk-free.
Look, it is already given that when you say your risk-free rate is, we just calculated 7.43.
Yeah.
30-year government bond is given as 8.95. That is what we are using the risk-free rate. As I just explained to you that we take long-term rate, We don't take Treasury bills rate because our projects are long-term projects. Okay. So in order to calculate your cost of equity, you have risk-free rate. This is from Exhibit 4 or 5. In 4, it is average market return minus average long-term government bond rate. So 12.01 minus 4.58, 7.43. This is directly given in Exhibit 5. 30% bond rate is given in table B in the textbook. As I explained to you, this is what we have to use. We have to use from here because it is the latest. So that is what we can do. Now then we have calculated cost of debt. And cost of debt is 8.95, all right? Okay, B2. And every time we are adding the different risk premium. We are adding different risk premium here. So we have calculated for Marriott, lodging, and restaurants. These are the ones, right? Now, for contract service, we are assuming that it is shorter, 10-year. You can change your assumption, okay? Because this information is giving, we are using a particular logic. If you change your logic, this will slightly change. I am using a logic that contract will not be very, very short-term contract because they may be contract to supply food to the airlines, for example, aircrafts, you see? That service may be there. And these contracts are generally between 5 to 10 years. Sometimes they are short. But you don't do for 1 year, you do 3 years, 5 years. So here I am using 8.72 plus 1.8. But you can still use 8.95 plus 1.8. So this is your cost of debt. So what is cost of debt? Cost of debt is the government bond current yield or rate plus the risk premium. Now here the Marriott levered cost is given 1.11. And this levered cost is exhibit, say you see exhibit 3. Okay. This is given in the text as well as here. So this is Marriott Corporation. This is Marriott Corporation. I hope you can see these numbers. I can increase the font size.
Nice there.
You can see?
So if possible, if you can little bit increase it, will be nice.
Huh?
If you can little bit increase it, it will be nice, if possible.
Okay, sure. Let me change the font size to 16. Okay?
Okay, sir. That's very much better. Yes.
So Marriott, this is the equity and this is the current market beta. All right? So what are you going to do with this? You are trying to find out the levered cost of equity, levered beta for equity for the new target debt ratio. This is actual, existing. Okay? This is actual, existing. But we have seen that in here they talk about debt ratio to increase to 40 to 60% here. All right. So if I change everything here, so even you can see that this will be, okay. Marriott it is 60%, lodging 74%, contract 40%, and restaurant 42%. These are target. So what is your problem? Your problem is that this ratio is relevant. Why it has gone? So I can increase this too. So what do you see? The levered equity beta here, this is levered equity beta, okay? 1.11 and actual debt ratio as given in exhibit 3 is 41%. So there is a problem of unlevering beta and levering beta. Okay, unlevering and levering a beta. Now, if I go back to my whiteboard, I don't know whether you can see it. Can you see my whiteboard?
Yes. No.
No, not
See,
yet, sir.
Excel, only Excel.
Not yet, sir.
Cannot see.
You can see the Excel file, sir. Maybe, sir, you have to go for a new share, sir.
Oh, I see.
Yes,
So I have to
please.
stop the first one.
Yes, sir. And go to the new share, sir.
Oh, that is a little troublesome. Okay, no problem. So where is my whiteboard? It is here. Okay. So let's understand. This is an important which everyone, the students will, that's why you need to devote more time in this case, because they will get confused and maybe they won't understand. So you have to go step by step. So now the equity beta, let me write it. Oh, even this pencil, because this is, you have to write like Americans sometimes. So, but anyway, I practice it. Now that's fine. So my equity beta is 1.1, but it's for my debt ratio of 41%. Now my target ratio is 60%. Target ratio is 60%. Obviously, then my levered beta should be higher than this amount. Okay? It should be higher than this amount. So what do I do? So this is your levered beta actually. This is equity beta, which is given the, so whenever you calculate beta for an equity based on the market data, that is through a regression. That is through regression. Return of company regressed against the return of the market. All right. And whatever beta you get, that is always levered, because those companies in the market, they have different kinds of leverage. Your company has zero debt, then your that beta is not levered beta. But generally companies would have some lever. Now, so first what you have to find out, beta which is unlevered. Okay? Which is unlevered. Now the first definition is unlevered beta is also called asset beta. You should remember that. I can write asset beta here, A. And generally it is as equity beta, which is levered, into weight of equity divided by value. Generally it's market value plus debt. This all comes from Modigliani-Miller model actually. Now here we simplify life and we say beta debt is 0. So what are you assuming? Unrealistically, you're assuming your debt is not very risky. Although we know it's risky. The moment you make it, it becomes very easy. Okay. Now, therefore, the unlevered beta for this company would be what? It will be 1.11 multiplied by what? This will be how much now? So how much will be your unlevered beta? What do you think? How much will be unlevered beta? Anybody who can tell me? Anyone? It will be multiplied by, what is the proportion of, because this is what your debt ratio is. So how much is the equity?
59%.
59. So how much do you get? Can you multiply and give me the number? How much? You don't have any calculator, any phone with calculator?
0.6549.
Okay, let's say it's 0.65. This is unlevered beta. So what are we doing? From levered beta, using the current ratios, we are calculating unlevered beta. And then, so this process is unlevering. But what is the assumption? Assumption we are making that this is risk-free. But if you can keep it, no problem. Then it will become complicated computation. That's it, nothing else. But generally, in practice, that's what people assume. Textbooks will give you details that if it is not risk-free, then what happens? All right. Now, from here, now you again calculate your equity beta, which is levered now. Okay. Which is levered. So my unlevered beta is equal to this. So what do I have? I have my unlevered beta. Let me write U here. Otherwise it becomes a little complication for me. It is BE levered into EV. Same thing which I'm writing. Same thing. All right, this one. I am assuming this one is here 0. And therefore, your levered beta is equal to BU, unlevered beta, divided by this, okay? Divided by E divided by V. From, this is mathematically. When you bring this term here, and this term here, this will go under. So actually here it is 0.65 divided by, for the target debt ratio is this. So my E divided by V will be 40%, 1 minus this, 100% minus this. So divided by, and therefore my levered beta for the target debt ratio, which is 60%, will be this one. So if you divide, 65 by 0.4. So how much it comes? 1.62. 1.62. Let us go through this one once again. That levering and unlevering, levering and unlevering beta. In American textbook, you will find leveraged and unleveraged, okay? In British books, you may find gear, ungeared, or lever, unlevered. So Americans use different spellings for many things, okay? So they say leverage, we say lever, or we say gear. Same thing. Of course, mechanically they are different, gear and lever, different things, but their function is the same, to speed up things. As you introduce more debt in your capital structure, if everything is favorable, then your EPS increases. So it increases your speed of earning. That is the concept of lever. Lever gives momentum. It's a mechanical engineering term brought in finance. Okay. So now you can calculate cost of equity for this company, where you have levered beta recalculated. So here your risk-free rate, we got it from table 4 or 5 was 7.43%. plus, is that so? Is that so? Is that 7.43?
No, sir, 8.99.
Yes, you're right. So class 1 has to be quite active actually. Teacher may forget. And this was 7.43% multiplied by the beta which we have calculated. That will give you equity. All right. So how much you get?
21.
If I look at my Excel calculation, so you are right, it gives you 21 if you want to approximate, or 21.11%. So what you have is, you have, if I assume 34% or 44%, depending on that, I have after-tax cost of debt and I have my equity. So I can calculate after-tax WACC. So 21% multiplied by 40%, because my equity is 40%, plus whatever is this amount. In my calculation, I took 34, I don't know why, and I got cost of debt being less. Naturally, it will be less there. Whatever I get, so that cost of debt multiplied by 60%, and I will get Marriott's WACC. Is that clear? Okay. So this is going to take one session first. So what is in one session? That look why this company uses hurdle rates importance. Importance is investment, importance in, but you have to go, they don't just be satisfied when they say that it is for investment analysis. You say in this company, what is the importance with regard to, so exhibit, that first page exhibit, from there they have to tell you how much loss there would be even if they make minor mistakes in calculating hurdle rates. Then the second point is incentive, compensation. And you can again devote 1-2 minutes in exploring further from the students. Then you come to things like capital structure designing can also take place, because you want to optimize your capital structure where cost of capital is important. Because if you go for higher target debt ratio, your WACC will come down. You'll be able to accept more profitable projects. And then the last, which again requires at least 5 to 7 minutes discussion, is repurchase of, or maybe more, repurchase of shares. Then you say how we will calculate cost of equity, cost of debt, cost of capital, which is WACC for Marriott. So cost of equity and cost of debt. If they have already done dividend growth model, you say now, what do you think? Which method? Obviously, it's written in the case itself, capital asset pricing model. Then ask them to recall the components, the risk-free rate, risk premium, equity beta. Again, devote that time on risk-free, because the risk-free rate in the computation is the latest, current. But the premium is based on the averages. I think this is a point which I found even when I go for teachers' interviews, even at associate professor level, they fail on this question. Because they don't know. Unless teacher reads books and theory very carefully, it's difficult. Now, then you come down to the, of course, you then make the calculation. Ask them to make, let them make mistakes. You say, look, but you have to make some, you have to give me some numbers. So some numbers are available in the text, some are available in the exhibits. Current rate is available in the text, while the premium is available in the exhibits. You have to tell them the logic of taking long term, because it takes care of several cycles, economic cycles. There are ups and downs. Okay. Longer the period, it will cover all kinds of cycles, downturns and upturns, and then constant where no changes are taking place in the economy. So it takes care of all of that. So average is not the best way, but then you have no alternative. That is the best alternative. Shorter periods may introduce more volatility in the market. You see, there are some periods where market is is only going up and up. Sometimes it's going down and down. Sometimes it's fluctuating. So you can't take short terms, but that doesn't remain so over a long period of time. There will be fluctuations, which is bound to happen. That's why long. So that logic has to be explained. Well, there is a technical point, of course. Why not geometric mean? Anyway, I'm not going to explain that, but then why not geometric mean? Why arithmetic mean? Because capital asset pricing is 1 year model. So you are saying 1 year, simple logic, 1 year rates added. That is the average which I am earning, rather than keeping that stock with me forever. So there are hundreds of investors, they are selling and buying every year. Therefore, you are calculating on that basis. That's the simple logic for arithmetic average. Okay, then you come to the divisions. And in case of division, that of course, you have to go through a little longer thing. If I go back to the case, now what you have to go through is exhibit 3. Sorry, I will go back to I'll stop share and go to my Excel file. So where is my Excel? Here. And I go to exhibit 3. Okay. Now here I have comparable firm. I don't have data for the divisions because they are not operating in the capital market. So these are so-called comparable firms. Actually, they are not comparable if you look at the sales. These are sales figures. These 4. This company is much larger. If you look at exhibit, let's say which one? Q perhaps. Yeah. So if I look at exhibit 2 and let me say 16 point. So what you see is that sales in this year, okay, you have 2.7 billion. And here, none of them is that. This is a little closer. So conveniently what people do is they take average and weighted average. Now this average is simple. Okay, if you look at here, what are these numbers? You have arithmetic average of return, you have equity beta, you have market leverage. So you don't know leverage of this company, you don't know, but target leverage is given, of course. So if you take average, 1.09 and of beta, and then you have 0.57 of leverage. And this is average, but we don't need average here. We need sum of sales. So this is sum of sales. Okay. So what are these numbers? These numbers are averages. So can I take average is the question. Answer is yes and no, because there is no theory now. Or can I take sales as the basis to compute? So I'll take weights. So what are my weights? My weights are here. This divided by 3.35, which is common, of course. So I have, so these are my sales weights. Well, because these numbers were not there, so 0 has come. Now you can eliminate them. Of course, in Excel, there is a way where you can, there is a small function where you can avoid zeros since there are no numbers. so you can avoid. So I will not teach Excel now. I will teach only finance. So what you do is you just beta multiplied by the company's sales. And if you calculate that here, 3 of them, and then sum, so you get 90. So you can use either 1.09 or 0.9 because it is weighted. Weights are based on the sales. Okay. Market leverage is 59. Sorry, market average is 57%. So there is no theory now. Okay. You can take the best one single company which is very, very close and comparable. So in the examination, if there are intelligent students in your class and one of them argues that I will take this is closer to the company, you cannot say 0 marks. You cannot say, but the sales are 1.66 and beta is 1.35.
So
but the same higher. You can take 1.09, whatever. Anyway, so now what you have is you have levered beta average. Let's say this average or this average, whatever is the average. This average, this is wrong actually because here zeros, it should be around 1 in my opinion because I had calculated it earlier. Because it has counted, it has divided by so many of them. If I simply say a sum, let me see if that comes or not. Kuch to problems, there is some problem. 1, 2, 3, and this, sorry, this was not included. This was not included. So if I add this plus this and this, and then divide by 4, of course, I will have to put a bracket here. You could go, I think there is some problem in my calculator. Anyway, it will be around that 1 or 999 or whatever. Let me check my Excel sheet solution. Well, there were actually my beta average beta is 0.42. Weighted beta is also 0.42. So I made certain mistakes. Okay. So assuming that you have got your beta now, okay, now we have information about 4 companies as far as lodging business is concerned, okay? And so what we can do is that we can take simple average, which is 0.42. Now what I did is that this is the levered beta. These are the equities of each of the companies. All right. This is market leverage. Sorry, the first column is market leverage for each of the company. The second one is market equity. This 0.86 is the market equity. This is difference. Actually, this is given in the case. The market leverage is given in the case. Let me see what is given in the case. Whatever is given in the case, on that basis, you can find out the missing one. So 14% plus 86% is 100%. So the leverage is 14%, equity is 86%. This is from Exhibit 3. Then it is 79%, 21%, like that. Now, and then the equity beta is given for each one of them. That is your exhibit, this. So equity beta is 0.76, 1.35, 80.89, and 1.33. So I have put this equity beta here and again calculated unlevered beta here. Calculated unlevered beta the same way as we did. Okay. And then averaged. So the unlevered beta comes 0.42. This is simple average. If you take weighted, again it comes 0.42. It's the same. So it makes no difference whether you are taking, but that is not general concept. Generally, the weighted average is taken. You can take asset as the weight or sales as the weight. Okay. Here only the sales information was given. So we took sales, revenue. They called it revenue. Okay. Now this becomes your unlevered beta. Depending on the target debt ratio of each division now. So your unlevered beta is there. You can calculate the equity beta. It is unlevered actually. So you can calculate the equity beta. Now the target ratio is 74, debt ratio. Equity must be 26%. So when you, okay, then you can calculate the equity beta. Similarly, so this is the same procedure as in the case of Marriott, except that in case of Marriott, we directly had the information about unlevered beta and debt equity ratio and debt ratio, and we calculated unlevered and then levered beta. Same thing is here. The only long process is how do I get unlevered beta here based on the comparable firm. Same procedure is being used. The only thing is which one do we choose? So we said we will average them, either simple average or the weighted, sales weighted average. So I am saying we should take sales weight, means weighted, sales or assets, whichever figure is given to you. Same procedure you will do in case of the another division, which is your restaurant. All right. So you can see what I will do is I'll send this exhibit to you, these calculations. You go through it and then do yourself. The important thing is that how do you calculate now cost WACC for the contract service as no information given except the target debt ratio. Okay. I have shown in this exhibit and I will send it to you and then you can try. Okay. So we will stop here. I will send it to you, and next time when you don't follow any of these things, you should ask me. You should make your own calculation after going through this carefully. Is it okay? Okay.
It is okay, sir.
So what I'm saying is structure your course, your case in the course. You can give them some quick reading also along with the case. Divide your case discussion into certain parts, and on the blackboard or the whiteboard, that's what you will be writing. So you will be saying, answer this question and go on writing their answers. And then discuss them one by one, right or wrong. All right. And similarly then calculation, but always force your students to answer. Don't do it yourself. If they are not able to do, you do it. And wherever the technical points, there would be difficulties. So you can explain, but first let them try. They must struggle. Once they have struggled, they understand what the problems are, which they couldn't solve. If you straight away tell the problem and how to solve, they will never understand that this was a real problem. Okay? So please do it and then ask me next day.
Okay.
What will be my plan? My plan will be to divide this case into two parts. In the first day, I am focusing on the need for the hurdle rates. And the second point, the computation of WACC for Marriott. Within WACC, cost of equity, which brings use of capital asset pricing model. And then the clarification with regard to risk-free rate and risk premium. Risk-free rate is the most recent rate. And risk premium is the average of market return long-term minus average of long-term government bond. You can use treasury bills also. That is the textbook prescription. Only thing is that the computation will change. All right. But I have given you the argument for using long-term rate. That is my first day. Second day, I am concentrating on divisional cost of capital and the method, indirect method, using the competitors who are very, very close. If somebody is very close to you in terms of sales, for example, I think it's better to take that company's beta as your divisional beta. You don't need to average then. But if you find there are differences, then average is better. Okay. All right. I will be changing case for the next class. I will be giving an Indian case. I will send it to Vasanta today night.
Okay.
Get to you.
Okay. So, thank you very much for your kind thought and giving guidance for our teachers. And today we learned a lot, and every day we are learning, but today we learn a lot on the cost of capital. You spend a lot of time for Sri Lankan teachers. So, do you have any plan for the final day, sir?
No?
Any plan for the final day?
He's going to do an Indian case, no, sir?
Yeah.
And
they need to be present, or?
I'll write the instructions.
Okay,
sir.
Okay, we will send the instruction later, and thank you very much for your participation.
Thank you very much. Thanks a lot.
Thank you very much, sir. Okay.
Thank you very much, sir.
Good evening, sir.
Thank you very much, sir.
Bye.